Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu. Makes it 4 o'clock in New York, which means we do have U.S. equities closing on the day. We've got green, whether it's for St. Patty's Day or just for the fact that the Fed announced yesterday we will not see an interest rate hike. We have got a nice rally underway. Dow Jones Industrial Average up about 157 points, almost a full percentage point gain on the day, 17,485, low 297 in terms of the low, and the high has been 529. So we're a smidgen off the high, but definitely closer to the high than the low. And that spells a good report card, so to speak, for our current trade, in which we are long a E-mini Standard & Poor's 500, which is currently trading at 2031, 2032 on the day. Of course, we got in at 1979. So we've got 32 points. We're up about 52 points right now on the trade. We did trail our stop up yesterday. We'll talk about correct stop placement, also where we think this market could head, and where we're looking at as our next level of resistance. So traders, the first chart that I do want to look at today, a simple daily chart, Standard & Poor's 500 E-mini, with our basic fib retracement that we have been using to calculate support and resistance levels, beginning at the low of the August meltdown up until this top at about 2109. We talked about the fact yesterday, and I think it cannot be overlooked how significant it was, but two major factors going on a technical basis. The first was that we had pegged our resistance at that point at roughly a 2000 to 2003. It's a century mark. I call it a straight even 1,000 number, 2,000. It's also a pretty strong fib number because it is that 38% retracement of the August meltdown. So I've always seen that as a fairly significant number. Now, we can also see where, on a technical basis, we found to some degree in this area, but definitely right in here, that it acted as a supportive factor on a technical basis. So that was important. Even more so is the fact that we broke above on yesterday's trading activity. We broke above that 200-day moving average. As we have talked about, the most critical thing to a technician as we look at long-term moves in the market is that 200-day moving average. I've just pulled up our weekly chart, and on this weekly chart, you can easily see, and these numbers in terms of where these moving averages aren't to scale, as you can see, it's 52 and 12, but we are above it. And the one thing that you can see is that this long-term moving average, and that's really what I'm trying to supplement. I'm going with a 52-week rather than a 200-day, 200 trading days. But when we look at this, you can see that as this market has moved to higher ground, it has consistently had a price point which has remained above that long-standing moving average. So traders, the next chart that I do want to look at, it's the same daily chart that we started with, although this particular chart is in Henkinashi or Japanese average format. The reason for pulling that out is it is a good way to really attempt to determine the strength of the current trend. We've got our 50-day moving average back in, as you can see. Now, you do have a very, very small wick on the lower end of this candle, and you typically want to have none to a very, very small wick, because what that says is that at no point did it trade at or below the midpoint of the prior candle. In the case of today's activity, being a daily chart, it did trade at and just a tick below the midpoint of the prior candle. Now, we've seen a nice move, and it's trading well above this particular price point. So I still think we've got some good solid activity and potential to the upside on this particular component of the rally. However, I also see some resistance coming in roughly at 2043 when we consider the high of the day. That came in at around 36, so we haven't really gotten there yet, but we're fairly close, and we do want to see if we get any kind of resistance in this area. But traders, to me, it is a minor level of resistance, although it's a 23% retracement. If you look back at price action through this particular price point, you'll see that you really can't derive any strong information of either support or resistance. So traders, just a couple of quick footnotes. First of all, dollar under tremendous pressure, down 1.2% on the day, 94.75. Look at that tremendous break, and on a longer term basis, I don't really see any real support coming in till about 94 even, 93.80, and it's based upon, of course, this low right in here. And so traders, lastly, do want to take a look at crude oil. Crude oil up over $40. And as you know, I have kind of put out on record that I was looking for oil to go as high as 40. Let's see if it can continue its dramatic rise, because when we take a look at some of the indicators such as stochastics and MACD, which is what we have MACD here in stochastics, we know that this particular move down put the market in an extremely oversold scenario. This is a monthly chart. Look at that tremendous low and then that spike. That, to me, is something we definitely want to pay attention to. And traders, it's been my pleasure really to inaugurate this particular component of the gold forecast, trending markets, because my sense was that especially with the equities markets, they sometimes run in tandem, as we saw yesterday, gold up, equities up. However, for the predominant, most of the time, they tend to run counter to each other. So we might get a bullish move in gold, why we see the equities markets under pressure, risk on, risk off, so to speak. And the interesting thing is, by combining the opportunities with the Standard & Poor's 500 and gold, so we've been flat gold for about a week, but now we're profiting from the Standard & Poor's, and the reciprocal will probably happen. At least that's my hope, is that as we're pulling profits on the S&P and going flat, that's when gold's ready to make its move, and then we hop back into that. So it seems as though we're on the right track. We're definitely onto something in which we use multiple instruments to try to capture as best we can profits out of the market. This has been Gary Wagner, wishing you, as always, good trading. We're certainly getting that this week. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.